Moving on now, let's talk about the dividend yield. This is the percentage that a company pays out in dividends relative to its share price, and it's calculated by taking the annual dividend payment and then dividing it by the share price. Now, since dividend payouts and the share price both change over time, the yield that a stock or fund pays is also going to change over time. Let's say, for example, you have a stock trading at $100 per share, and they've paid out $4 in dividends over the last 12 months. You would take that $4 in dividends and divide it by $100 in terms of the share price, and that would give you 0.04 or 4% as the dividend yield. But there is a catch here when it comes to high-yielding dividend stocks. Oftentimes, this could simply be a result of a stock having a share price that's declining in value. If the same stock in the previous example dropped to a share price of just $50, but still had the same $4 in annual dividend payments, you would divide the $4 by 50 and end up with 0.08 or an 8% dividend yield. Inexperienced dividend investors might see an 8% yield and think it's a great deal because it's so much higher than everything else out there, failing to realize that the only reason why the yield is so high is because the share price has dropped. The crazy thing is, companies can even pay dividends even if they cannot actually afford to do so. In most cases, they're just trying to keep investors on board because they're pretty desperate.